Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about China Next-Gen Commerce and Supply Chain Limited Annual Report. China Next-Gen Commerce and Supply Chain Limited market capitalization of $5 billion is significantly larger than the average industry peer of roughly $0 billion. This shows that China Next-Gen Commerce and Supply Chain Limited holds a significant advantage in their industry. China Next-Gen Commerce and Supply Chain Limited trades at a higher price-to-book ratio of 29.94 times relative within the industry. But when we look at the broader industry, much for its peers are also priced fairly or higher. This indicates an overall sector-level optimism, suggesting that most investors have already participated in the industry, leaving limited opportunity to uncover undervalued stocks. The company maintains a moderate leverage profile, with liabilities making up 61% of total assets, suggesting a balanced approach between risk management and capital efficiency. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has declined over the past 5 years, but operating income remains positive. The equity weakness may stem from capital structure changes, such as buybacks or dividends, rather than operational deterioration. The share count has remained broadly unchanged, indicating no significant dilution or buyback activity over the past 5 years. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. China Next-Gen Commerce and Supply Chain Limited offers a diverse range of services and businesses through its two main segments: construction services and property investment. The company's construction services include civil engineering work such as road, earth, drainage, and soil improvement projects. It also provides building construction works for industrial buildings, including substructure, piling, addition and alteration, electrical and mechanical works, and other ancillary services like logistics and transportation of construction materials. In addition to its construction services, the company invests in and leases residential and industrial properties, catering to both government and commercial corporations. This comprehensive range of services makes China Next-Gen Commerce and Supply Chain Limited a significant player in Singapore's construction and property investment market. The China Next-Gen stock price has skyrocketed in the past year due to a combination of policy shifts and emerging trends. A key factor was China's policy pivot from deleveraging to an expansion phase, which led to normalized credit conditions, increased fiscal spending on innovation, and improved private sector sentiment. This shift laid the groundwork for sustainable growth. The Chinese stock market also outperformed global markets in 2025, driven by new growth drivers and better-than-expected geopolitical developments. The focus on productivity and innovation has led to healthier corporate balance sheets and improved earnings visibility, driving the next phase of China's economic evolution. A significant driver of stock gains was the frenzy for AI-related shares, fueled by the government's push for homegrown technology and major investments in AI infrastructure. Tech giants like Alibaba Group Holding announced substantial investments in AI, boosting market confidence. The emergence of new Chinese AI chip companies, such as More Threads, also contributed to optimism. China is prioritizing strategic emerging industries, including AI, semiconductors, green energy, advanced manufacturing, and biotech. The country is rapidly advancing in areas like AI solutions, robotics, and biotech, with the 15th Five-Year Plan expected to spotlight these sectors. Overall, the China Next-Gen stock price has skyrocketed due to a combination of policy shifts, emerging trends, and government support for innovation and technology. The primary drivers of revenue growth or decline can be identified by examining the key factors that have contributed to an increase or decrease in revenue. On the growth side, services have been a significant driver, with a 10.8% increase in revenue. Within construction services, civil engineering works and other ancillary services have seen substantial growth, with increases of 17.1% and 24.6%, respectively. Rental income from property investment has also grown by 7.3%. Additionally, the strong performance of certain customers, such as customer I, IV, and V, has contributed to revenue growth. Furthermore, the growth in construction services, particularly civil engineering works, has been a major contributor to revenue increase. The expansion of property investment business, including residential and industrial properties leasing, has also driven revenue growth. Strong economic performance in Singapore, with a revised GDP growth forecast of 4%, has further boosted revenue. On the decline side, rental income has seen a decrease of 7.1%. Building construction works have declined by 98.9%, which is likely due to a one-time project completion. Government grants have also decreased from $30,745 to $18,970. Additionally, other ancillary services have experienced a decline in revenue, attributed to a non-recurring item. Net income and profit margins of the company underwent significant changes. The net income decreased by approximately $0.1 million, indicating a decline in overall profitability. This decrease was largely due to a reduction in contribution from other ancillary services. The gross profit margin also experienced a decline, decreasing from 8.6% to 8%. Although the net income margin is not explicitly mentioned as having changed, it can be inferred that the decrease in gross profit margin had an impact on it. However, this decline was partially offset by an increase in gross profit margins from construction projects driven by cost management improvements. Based on the extracted summaries, it appears that the company is not generating positive operating cash flow. The financial data reveals a significant shortfall in the company's ability to generate cash from its core operations. The numbers tell a clear story. The company's operating cash flow is a staggering negative $10,149,515. This indicates that the company is struggling to cover its operational expenses, resulting in a net outflow of funds from its core business activities. This negative operating cash flow raises concerns about the company's financial health and sustainability. It suggests that the company may be relying on external funding or other sources of capital to stay afloat, rather than generating sufficient cash from its operations. The company's financial health has shown significant improvements in the past period. A notable change is the decrease in total debt level, which dropped from $18.6 million to $15.6 million. This reduction indicates a more stable financial position for the company. Furthermore, interest expenses have also decreased substantially. The company has managed to reduce its interest payments across all types of liabilities, including bank borrowings and lease liabilities. Specifically, interest expenses decreased by approximately $0.3 million, from $0.9 million to $0.6 million. These changes suggest that the company is better equipped to manage its financial obligations and may be able to allocate more resources towards growth initiatives. The recent financial summaries reveal mixed results across various segments and regions. On the positive side, construction services in civil engineering works and other ancillary services have shown strong performances. These sectors have been able to meet or exceed expectations. However, some areas have struggled to keep pace with the company's overall growth. Building construction works within construction services have underperformed, while rental income from property investments has not seen significant increases. Furthermore, civil engineering works have faced issues related to unsatisfied performance obligations, contributing to their poor showing. Overall, these segments and regions require attention to improve their performance and align with the company's overall growth trajectory. Management's outlook on the company is optimistic, with a notable increase in revenue of 10.2%, attributed to enhanced project progress and growing demand for civil engineering services. This positive trend suggests that the company is well-positioned to capitalize on emerging opportunities. In terms of strategy, management has indicated a cautious approach, opting not to pursue material investments or capital assets as of September 2025. This decision implies a focus on maintaining financial stability and prudence in resource allocation, rather than aggressive expansion or diversification. There is no notable activity in terms of acquisitions or divestitures. The company has not made any significant purchases or sales of assets, businesses, or subsidiaries that would be considered material transactions. This lack of activity suggests a stable and focused approach to business operations, with the company choosing to maintain its current structure and resources. The company's financial strategy has been transparent in its recent reports. One notable aspect is the absence of dividend payments to shareholders. According to the information provided, page 13 explicitly states that dividends have not been paid out. This decision suggests that the company may be prioritizing other areas of investment or focusing on internal growth. Furthermore, there is no mention of share buybacks in the extract. This implies that the company has chosen not to repurchase its own shares from the market, which could indicate a focus on expanding operations rather than reducing outstanding equity. Overall, these financial decisions provide insight into the company's priorities and strategic direction. There are concerns regarding the stability of a project's supply chain. Specifically, there is uncertainty surrounding the reliability of subcontractors, which could result in cost overruns or delays. Additionally, there are concerns about the availability of labor, which may lead to increased costs and negatively impact competitiveness. These issues highlight potential vulnerabilities in the project's supply chain. That concludes the financial summary for China NextGen Commerce and Supply Chain Limited. Feel free to comment below, and I will be happy to answer them when possible.